Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 3rd of October 2023. So the US dollar remains in sharp focus. We've just seen the release of the ISM Services PMI, which came in stronger than expected at 54.9 compared to 51.7 expected. This comes on the back of a few other stronger than expected economic indicators this week, namely ADP private sector payrolls report, which came in at 143,000. And JOLTS job openings, which came in at 8.04 million, which was more than expected. We've also heard some not so dovish comments from the Fed Chair Powell earlier this week, suggesting that another 50 basis point rate cut was unlikely this year, while other central banks and governments have been dovish about interest rates in their countries. For example, the Bank of England Governor Bailey today said that the Bank of England could get more aggressive with its own rate cuts, which is why you see the pound being the weakest currency at the moment. We've also heard from the Japanese Prime Minister yesterday saying that the current interest rates in Japan are appropriate and that the central bank should not raise interest rates any further. That caused the Japanese yen to slump, and we saw all yen crosses rally, like the dollar yen, euro yen, pound yen, etc. The pound yen has come back down a little bit because of the dovish comments from the Bank of England today. The euro dollar has been going down for 5 days in a row, hurt in part because of increased risks in the Middle East, which has weighed on risk sentiment a little bit. And now it's coming down to test this key area of potential support between 110 to 110.25, this green shaded area. This is where previously the euro dollar rallied from. So a potential break below this area could be a technically bearish development, which could then pave the way for a potential drop to 109 area, which is where the next area of support comes in. This area being prior resistance and support, and it comes in just above the 200-day moving average. Will we get there this week? Remains to be seen. I think a lot will depend on the outcome of the jobs report tomorrow and how strong or otherwise the Israeli government is going to respond to those Iranian attacks a couple of days ago. So if we see an aggressive response from them, that could raise concerns about a potential war breaking out in the region. That could send oil prices sharply higher, potentially raising inflationary concerns. In turn, that could hurt risk-sensitive currencies like the euro and support the safe haven US dollar. In the equity markets, we haven't really seen a major sell-off yet. Markets have been basically consolidating their gains in the last couple of weeks, awaiting the release of the jobs report, and with some investors sitting on their hands because of raised geopolitical concerns. So far, support area, the shaded blue zone, holds, which was previously resistance back in July and again in August before we broke out in September. So if we go back below the zone, I think that would be a bearish development, but until and unless that happens, the path of least resistance on the S&P 500 remains to the upside, simply because we are very close to the previous record high that was hit only a couple of weeks ago. So we could be heading further higher in the not too distant future should we see de-escalation in the geopolitical risks concerning Iran and Israel. The focus will then shift to other macro factors, including, for example, the upcoming US elections and company earnings results in the next couple of weeks. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. See you in the next video.